We are covering the fundamentals of gift tax, specifically focusing on what triggers a Form 709 filing requirement. The cornerstone of this topic is the annual exclusion, which for 2025 is $19,000 per recipient or donee. This means a person can give up to $19,000 to any number of individuals during the year without any gift tax implications or filing requirements. The exam will test what happens when you exceed this amount. Imagine a client gives her nephew $25,000. Since this is more than the $19,000 exclusion, a taxable gift of $6,000 has occurred. This requires the client to file Form 709, the gift tax return. A common exam misconception is that filing this form automatically means tax is due. This is incorrect. Filing the return reports the $6,000 taxable gift, which then reduces the taxpayer's lifetime gift and estate tax exemption. Tax is typically only paid once this substantial lifetime exemption is fully exhausted. The key takeaway for the exam is that a gift over the annual exclusion triggers a reporting requirement, not necessarily an immediate tax liability. Another critical area tested is the concept of present versus future interest. The annual exclusion is only available for gifts of a present interest, meaning the recipient has the unrestricted, immediate right to use and enjoy the property. An exam question might describe a scenario where a grandparent transfers $50,000 into a trust for a grandchild, but the terms of the trust state the grandchild cannot access the funds until they turn 30. This is a classic gift of a future interest. Because the grandchild does not have immediate access, the $19,000 annual exclusion does not apply. The entire $50,000 gift is taxable and must be reported on Form 709. Married couples have a special tool called gift splitting. This allows them to treat a gift made by one spouse as if it were made one half by each. This effectively doubles the annual exclusion to $38,000 per donee for 2025. For example, one spouse can give $38,000 to their son. By electing gift splitting, the gift is treated as $19,000 from each spouse, completely shielding it under the annual exclusion. The exam trap here is that to make this election, the couple must file a Form 709 to signify their consent, even though no taxable gift results. If they don't file, the original spouse is treated as having made a $38,000 gift, resulting in a $19,000 taxable gift. Finally, do not confuse gifts with qualified transfers. These are payments made directly to an educational institution for tuition or directly to a medical facility for healthcare expenses. These transfers are completely unlimited and are not considered gifts at all. They don't use up the annual exclusion or the lifetime exemption, and they don't require a Form 709. The exam loves to trick you on the direct payment rule. If a father gives his daughter $30,000 to pay her college tuition, he has made a taxable gift because the money went to her first. If he had paid the $30,000 directly to the university's bursar's office, it would be a qualified transfer with no gift tax consequences. To remember these core rules, use the phrase, for gifts, think PEM, that is, a present interest is a must for the annual exclusion, while direct payments for education and medical are a bust, meaning they bust the gift tax rules and are not considered gifts at all. This simple phrase helps separate the three most commonly tested scenarios you will face.